That could destroy a person's portfolio. And let me tell you, the number one enemy to fixed investments, and when I say fixed, I'm talking about bonds, CDs, money market. All of these are at risk of inflation. If you have a bond paying 5% and inflation is 6%, you are losing 1% in spending power a year. And you're basically trapped because the bond payment is going to be exceeded by the inflation payment, and therefore we're in a lot of trouble. Now, let me tell you what we've got available to us. And Steve, how risky is this? It is the safest of the safest investments you can make. And that should perk your ears up. Let's move on and talk about this. Let me show you how this works as I tell you what it is. All right, let me just tell you what this is, folks. T.I.P.S. or T.I.P.S. Treasury Inflation Protection Securities. Now, I'm going to show you how this works and keeps your money, your spending power intact. And we're just going to draw a line here, and this is going to be a 30-year view. Now, you don't have to keep it for 30 years, but bear with me. And I'm going to make a couple of things constant. Your interest rate is going to be 3%. Your inflation rate is 2.5%. Now, of course, those won't stay the same in normal conditions, but for our illustration, those are always going to be the same thing. Now, here's one of the quick differences between a TIP and a bond. In a bond, the interest rates fluctuate, but what they pay on, which we call par, never changes. The principal doesn't change. The value may fluctuate, but the interest pays on a fixed rate. So interest rates change, the principal doesn't. In a TIP, it's the exact opposite. The interest rate stays constant, but your principal is going to change in value. Here's how it's going to work. We're going to put $10,000 in, and this 3% is going to pay twice a year, 2 times a year, so it's going to pay 1.5% every 6 months, okay? Another constant here. So the first 6 months, we get paid 1.5% or $150. That's your interest check. It's paid to you. Take it, do whatever you want to with it. 6 months later, it's now 1 full year. You're going to get paid 1.5%, but of what? Remember, inflation is constant, 2.5%. Your $10,000, due to that number, is now going to be worth $10,250. Your interest rate is going to be paid on that amount, which comes out to $153.75. So that $375 has kept your spending power intact. Now let's move up a little bit farther. Let's say that we go up to 10 years. Right now, at this point, with 2.5% a year being added, your principal is worth $12,800. 1.5%, remember the percentage stays constant, your principal is changing. It's going up with inflation. Now your check is $192, and matter of fact, $192 even. That's your paycheck, folks. In 10 years, this is worth $12,800. You're getting $192. Let's move all the way up to our 30 year. In 30 years, your principal will be worth $20,975. 1.5% of that will equal a payment of $314.62. Look at this. $150 was your interest payment 30 years ago. Today, it's doubled. It's more than doubled because it kept up with inflation. And then when this matures, all of these interest payments are in your pocket. You get a check for $20,975. That covers all the inflation, and you made a true, what we call a real rate of return of 3%. Folks, let me give you a couple of caveats here. Yes, you pay taxes on the interest, but you also pay tax on that appreciation in your principal. You don't get the appreciation in your pocket until it matures, but you pay tax on it. So this needs to be done in an IRA or a tax-deferred environment. That's very important. Otherwise, you're going to be eaten up with taxes all the way as it goes. The second thing is, in the short term, these can be very volatile. These are not short-term investments. They're made to be held for years. They don't have to be held for 30, but 10, 15, 20 years. And folks, it will pay off. So know what tips are. If you need more information, contact us, contact your advisor, and find out more about this. And remember, the quality of life is not summed up just by the quantity of your possessions. We'll see you next week on You, Me, and Wall Street. Good night. If you had waited, and what do we do? This thing is solid, isn't it? Studies have also shown that 4% is a number that, I know. I wanted to say one other thing. I didn't get it done. Well, at least it's only one page. Oh, I'm sorry. I'm going to that one, right? I just came off of this one. Okay. I'm sorry. Go again. Yeah, that's why I was confused. 3, 2, 1.
If you would like to contact us, call 501-223-6000 or go to our website, youmeandwallstreet.com. We'll see you next week for another edition of You, Me, and Wall Street.